Picking Options by www.options-trading-education.com. Picking options is like picking stocks in the stock market, but more involved. In the stock market, you can buy a stock or short a stock. In occasional options trading, or if you are making a living trading options, there is more to do in picking options. The first choice in picking options is to choose what to trade. The Chicago Board Options Exchange lists index options, equity options, options on ETFs, and holds interest rate options, leaps, binaries, weeklies, quarterlies, and flex options, CFLEX, on their product list. Once you choose a category, such as equities, you will need to choose a subcategory, and then the underlying equity. Once you have chosen what to trade, then you need to decide on how to trade with puts or calls, covered or uncovered. You will want to find options whose underlying equities are going to vary in price if you are buying, and going to be stable in price if you are selling. For the large number of available option categories, you will have to decide if you will trade equity options, index options, or the likes of leaps, binaries, or quarterlies. The technical aspects of the various kinds of options trading by category are similar. It is the nature of the market, your degree of interest in, and your knowledge of the underlying that will help guide you to the right options trading choice for you. Once you have chosen your category for options, you will need to choose the underlying itself. Using equities as an example, picking options means you will choose which type of equity to trade. You can trade options on stocks, or you can trade options on commodity futures. Depending upon your expertise and degree of interest, you will choose the underlying that looks most promising to you. Choose to trade in something that you know about beforehand and which you are involved outside of the market is useful. For example, a physician may choose to trade stock futures on pharmaceutical companies because this is part of his or her area of expertise. The manager of a farm cooperative may well choose to trade commodity options in corn and soybean futures because that is where he or she has a head start on other traders. This is part of risk management in option trading, starting with what you know and building from there. Picking the exact equity to trade requires both fundamental knowledge of the equity and analysis of its short and long-term prospects. Knowing which equity to trade options on and having an opinion on whether the equity will go up in price, go down in price, or stay the same will allow you to decide on option strategy. A long option strategy is safer because you already own the underlying equity. It also promises less return on investment, potentially, than a short options trading strategy. For example, a trader sells a call option on a stock. If the stock does not move in price, the option is not exercised. He or she gains the premium. In uncovered options trading, the trader gains the premium without an investment of capital. If the stock goes up in price, the option will be exercised. The covered options trader gains the premium, sells the stock, and loses out on the price rise. The uncovered trader gains the premium and needs to buy stock at the now higher price, sell at the lower, and will lose a multiple of the premium. For more insights and useful information about options and options trading, visit www.options-trading-education.com.